All right, everyone, let's take our seats and we'll get started. Good. All right. Welcome, everyone. Today is Thursday, January 16th. It's 1:30 in the afternoon. We have back the Department of Labor, Madam Secretary Portia Wu, and her panel, and we're going to get a briefing on the Unemployment Trust Fund and the modeling results. So I'll turn it over to you, Madam Secretary. Welcome back.
There. Am I on? Great. Thank you for having me back. Portia Wu with the Maryland Department of Labor. I'm joined here by Assistant Secretary Rachel Torres. She leads the Unemployment Insurance Division. She has joined our department since the last session, so many of you may not have had a chance to meet her, but I'm very excited to have her guiding the division. And then Mike Sayers, our Chief Labor Economist. We also brought a whole team here from Labor, and I particularly want to thank Urwa Faisal, who's the economist, labor market analyst who helped us do this modeling. I'm going to turn it over to Mike to walk through the details, but first, I just want to give a top line of where we are, and the current balance of the trust fund is $1.9 billion, so it is in good shape. It is only used to pay benefits. It is not used for administration and other costs, and we'll talk about later in the presentation about why we continue to see increasing costs in the UI system and some issues around administrative burdens there. These are just some overviews. I'm not going to go through them in detail. We are currently on Table A among the taxable tables, so that's the range, depending on individual employers' experience of what they may pay per year. And then finally, we continue to experience a very low unemployment insurance unemployment rate in Maryland. It is increasing, and we're seeing that in many parts of the country. The good part of that, though, is it's because more Marylanders are coming back into the labor force, which is something we sorely need for economic growth. So I know there are a lot of policy questions in front of the committee. I will just say what's going to happen is Mike's going to talk a little bit about, and actually maybe we'll go to the next slide, Mike, you know, the overarching question is, or the measure that we're using here is, where does UI fall in terms of general solvency? The measure we're using is the average high cost multiple. We'll talk more about that. I will say these projections are based on a U.S. Department of Labor model. It has taken us some time because Mike and the team were very diligent. We found a lot of sort of irregularities and discrepancies in the model. We understand nothing's perfect. It's a theoretical thing. But all of these factors that we share with you, you know, these are estimates, right? They're rough estimates. We modeled a couple different scenarios. The goal of today is really to give the committee that snapshot picture so you can, you know, figure out whether or what sorts of policy considerations you want to bring to bear. So with that, let me turn it to Mike.
All right, wonderful. Thank you all very much for having me. And so I want to start off just by kind of introducing the base concept here, which is that when we're thinking about unemployment insurance solvency, what we're thinking about is not just how large our trust fund is, but how much room we have to pay claimants when they make claims. And the way that we do that is through...
Hey, sir,
yes.
Sir, real quick. So it's been an upgraded system, and this is really just for anybody going forward. The microphones are not the best, so you got to speak almost directly into it.
Absolutely, moving a lot closer. All right, oh, that's better. All right. So I'll restart just for anyone that may not have heard there initially. But when we're thinking about how solvent our unemployment insurance system is, what we think about is not just the size, the overall size of the unemployment insurance trust fund, which, as Secretary Wu mentioned, is right about $1.9 billion right now, but how many potential claimants that trust fund can support. And so the way we do that is through this measure called the average high cost multiplier. It's kind of a complicated ratio of like 4 different things, but essentially what it's trying to measure is how many years of a typical recession could our current trust fund balance support. The target is 1, so generally we want to make sure that we have enough money in our unemployment insurance trust fund to support claimants through a full year of a recession. That is a target that is not just kind of a good idea from a state perspective, but that really lets Maryland do a lot of things. The most important is that we get interest-free loans to replenish our trust fund during recessions. So you can see the chart on the right-hand side of the screen That's showing our average high cost multiplier over time. And when there have been recessions, so the early 90s, 2001, Great Recession, COVID, there are large dips as we've been paying out high numbers of claims. There's often a very fast recovery in the average high cost multiplier. That's because we're getting loans from the federal government to replenish our unemployment insurance trust fund. The problem is, of course, we have generally had to pay interest on those loans that we get from the federal government. So at a time when we are in a recession, when we have a lot of other ways we would like to use that money, we're also having to make interest payments out to the federal government. We have only had our average high cost multiplier above 1 5 times in the past 40 years. And before 2023, the most recent time was 1996. So it has been a while since we have been kind of in the position that we find ourselves today, and where we have kind of the ability to take a step back and think about how we want to structure the unemployment insurance system and make sure that we are fully solvent moving forward. I just kind of also want to draw the attention to some of the general trends here on the screen. You'll notice that kind of before the Great Recession, our average high cost multiplier, despite some of the dips up and down, generally trending downwards. And then there was a bit of an upwards tick lately. And part of the reason for that is that lately we've had really, really low levels of claims. The Secretary mentioned our low unemployment rate of 3.1%. Currently, we're tied for the 10th lowest rate in the nation. We've had record lows of unemployment down below 2% for several months in 2023. In 2022 and 2023, we saw the fewest weeks of unemployment compensated for in Maryland, so actual payments made from our unemployment insurance system since 1969. It's just historically extremely low. Even pre-pandemic, Maryland had very, very low levels of claims that we were compensating for, which is great news because that means that Marylanders are not being laid off. We've got a good labor market, strong economy, and that does mean that more money is then flowing into the unemployment insurance trust fund and brings our solvency and our trust fund balance up. However, this is, again, historically, we've seen oftentimes the average high cost multiplier in our solvency calculations, that's tended to trend down. And so there's a couple long range reasons that we might think about why, just because we have a high cost multiplier above 1 right now, why that may not be the case moving forward. One of those is that, again, our unemployment rate is historically low. It's below pre-pandemic levels. 2019, we had a really, really strong economy, still had a higher unemployment rate then than we do right now. So it is likely that we may see a continued increase in our unemployment rate. As Secretary Wu mentioned, the recent rise in our unemployment rate is largely because of labor force expansion rather than an increase in layoffs. So it's for a good reason. People are starting to look for work again in the state of Maryland. But that may shift, and there may be some reversion to long-term historical averages there. Also on the cost, so that might increase the total number of weeks that we're compensating and that we're paying out. The average cost of those claim payments may also increase just due to normal inflation. I believe the average claim that we paid out last year in 2023 at least was about $330 or so. And that number has just steadily increased just due to overall inflation. So over time, there may be an upward pressure in the number of weeks that we are paying out, as well as the amount of each of those claims. And so that would put upward pressure on the costs that our unemployment trust fund is facing. At the same time, there are some pressures that are kind of muting our ability to grow revenue. For one of those, we have the taxable wage base. It's fixed at $8,500. I believe the last time it was increased was in the early 90s, 1992, I think. So it's been at that cap for a long time. And so what that means is that in order for revenues into our trust fund to grow, the main way that that's happening is through overall growth in employment. So we need to have more Marylanders working, or more jobs in the state of Maryland in order for revenues to increase. Obviously, there can be some variation in rates, but that's the primary mechanism. And then the other kind of long-range, long-term pressure here is just that over time, as we have a good labor market, the experience rating for employers is generally decreasing over time because they're not having to lay off workers. We're in a strong labor market. And so that that increase and benefit to them in terms of their experience rating is putting downward pressure on revenues as well because they're paying lower rates. And so when we think about how we're modeling our average high cost multiplier moving forward, we're looking at a couple of different scenarios. As Secretary Wu mentioned, we are using a model from the US Department of Labor. It's custom built for each state. They make this available to states all across the country. It's been done for Maryland in the past. There was some modeling done earlier by the Upjohn Institute. A number of other states use this model to estimate their unemployment insurance trust fund balances. I will say that we have not taken a deep dive. We've done some review of the model to make sure that things generally are kind of lining up, but it's not. We haven't done a complete evaluation. This is not a model that we have developed. And so there are still things that we're evaluating in this model. In terms of how we're building out scenarios, the largest driver of your average high cost multiplier and the solvency from kind of a macroeconomic perspective is really the unemployment rate. You can kind of make adjustments to employment growth or labor force growth or wage growth, but really the benefits that you're having to pay out in terms of the unemployment rate, that's really what's driving major swings in our solvency of the unemployment insurance trust fund. And so that's one of the main drivers of how we built out some of our scenarios. And so we have one which is a tight labor market. It's what economists refer to when you have the number of job openings is greater than the number of unemployed workers. And so that's, we had a pre-pandemic unemployment rate of about 3.75%. So we assume in kind of our one scenario that we have a continued tight labor market where it is a little bit harder for employers to find workers. And we're about at the unemployment rate 2017 to 2019 average. The second scenario that we modeled is a return to long-term historic averages, so 5.0%. That's roughly the 1990 to 2023 average for our unemployment rate. And so this is the projections that come out of this model from the US Department of Labor, assuming no changes are made to the program. You can see that regardless of kind of how we're modeling this increase in the unemployment rate, our average high cost multiplier remains above 1 through about 2028, 2029, before falling. The rate at which it falls is dependent on the overall unemployment rate because that's determining how many benefits are being paid out. And again, just to kind of bring this back, it's really the reason that you'll see that average high cost multiplier fall is because of the difference between the benefits we're paying out and the revenues we're bringing into the trust fund. So despite the fact that we have a steady unemployment rate in later years, the benefits are increasing over time largely because inflation is continuing to drive up the average claim payments that we're making. And so that's pushing more and more workers up against the maximum weekly benefit amount. And so typical growth in our labor market is just not enough to outweigh that pressure. And so one thing we want to do is find ways to perhaps balance out and bring those two lines into alignment. One thing I will note on the previous slide here is that according to this UNIS model, you'll see that our average high cost multiplier falls down quite a bit in the gold line, which is for a maximum unemployment rate of 5.0%. Up until the very last years of that gold bar, we are still in tax table A, just because of the way that the tax table triggers are set up. We don't actually move into a higher revenue system. And so one potential change that we explored through the modeling is just what happens if tax table A is dropped. What would that do to our average high cost multiplier? So that's what this slide is showing is kind of the initial preliminary forecast there. You can see that that does increase the overall solvency of the model. It's increasing the revenue that is coming in while keeping the benefits paid out the same as in the prior iteration. This is just showing the estimated benefits paid and revenues collected under the two different unemployment rate scenarios. As you can see, it's a little bit more closely aligned than in the previous slides. And finally, we were asked to do some modeling of some potential adjustments. So that includes modeling the maximum weekly benefits of 50% of average weekly wages, increasing the dependent allowance to $25, and then indexing that to inflation thereafter, as well as increasing the taxable wage base to 20% of average weekly wages. You can see that in these scenarios, the average high cost multiplier increases. The rate at which it increases is, again, dependent on the unemployment rate. So the gold bar, when there's a unemployment rate at kind of long-term historical averages, 1990 to 2023, it is above 1 at a much more stable level than if the unemployment rate is at a lower rate, more akin to kind of pre-pandemic levels. And this is, again, just showing benefits and revenues. And with that, I'll pass it back to Secretary Wu just to discuss this final slide.
Thank you, Mike, and we're happy to take questions or dive more deeply into the model. I think what it shows overall, and again, these are projections, but especially, we are enjoying a period of low unemployment, and that has been wonderful in many ways for Maryland, but I think those of us, especially who have lived through multiple labor markets, know that unemployment over a longer history, in some cases, has been much higher, and certainly in recession that can happen. Part of the idea of having more solvency in the trust fund is not only to make sure that we could, for example, avoid having to pay interest to the federal government, but also when the trust fund balances drop precipitously, that can create a hardship on employers, because that's when the tables start going up, and sometimes in some cases very quickly. And in a bad economy, to have those tax increases on employers is much more of a hardship. I did want to bring in this last slide attention back to something that we are working at the Department of Labor. We have a situation where we have a gap. We have a structural funding deficit in unemployment insurance. There have been reduced federal funds that we can't use our UI trust funds to pay for administration of the program. The federal government is supposed to do that. They have cut their reimbursement rate. And of course, when you have low unemployment like Maryland, you get less reimbursement as well, but you still have all the underlying costs. You still have to pay for the IT system. You have to pay for your contractors and call centers. You have to pay for all your fraud management and cybersecurity. And so we were able to close that gap with ARPA funds in recent years. Obviously, we're not going to be able to do that going forward. So the department has a proposal to, we're not allowed to use trust fund monies for administrative funds. So we have a proposal to charge a separate administrative fee and correspondingly reduce the contributions for employers so they would sort of net, and in that year there wouldn't be a change, but using a small portion of it to pay for administration, because quite frankly we're not going to be able to provide the services that we need to provide. I want to say 30 some other states have an administrative fee. I mean, this is very standard. A lot of states have already run into this problem. This is how they've been managing that. So that we can pause, and happy to answer any questions.
Thank you. First of all, it's good to see you, Secretary Wu, and
Nice
to your staff. It's wonderful, and Happy New Year to you.
Happy New Year.
My question, I think I kind of touched just a little bit. First of all, let me say good job in reference to keeping the unemployment low, especially during these times. Now, in reference to your projection for coming up, and I know for the state of Maryland, Prince George's County, did you do a projection or forecast or projection in reference to, would there be an increase maybe in reference to unemployment happening in Prince George's County? Are we aware of that, or no?
So we did not do a county-by-county breakdown, and the unemployment rate projections, I just want to stress, these are very rough scenarios, assuming that we get back to either pre-pandemic averages or kind of long-run historical averages. I think if you ask 10 economists to give you a forecast of the unemployment rate over the next 10 years, you're going to get 15 answers, and that may change even more so given some of the kind of larger questions that are looming over the next couple of years. So we have not done a breakout specifically by county.
Delegate, we're happy to provide you, because we can track sort of what the unemployment is. I do want to answer a question that I think is front of mind for a lot of people, which is if there are big changes in federal employment, what does that mean, especially for counties close into the district? Federal employees, and I'm going to look to my lawyers and everyone to keep me straight, they are covered, and the Maryland state system administers their benefits, but they're not like an insured employer where they pay in taxes to us and then we pay out. Federal employees are they're sort of direct pay, essentially, like we administer the claim and then we bill back to the federal agencies. So if they lay off people, they pay for that directly. It doesn't impact the overall solvency of the fund. Now, that's not true for federal contractors, right? So if there's a, a domino effect, a ripple effect with federal contractors, those are insured employers, and that would impact the trust fund overall.
Okay, thank you, Secretary, thank you. And you and I will continue.
Yes, happy to follow up
Okay,
with the
thank you so
details on
much.
that. Yes.
Thank you, Mr. Chairman. Just refresh my memory, Table A, that is the lowest cost table, correct?
Yes, it's where we are right now.
Did you say the rates were increased in Table A? Did I hear you say rates were increased?
No, they haven't been, two things. One, we're in Table A right now. One of the proposals had been, because the rates are quite low on Table A, especially I think a very large portion of Maryland employers are not only on table, in any table, they're on the lowest experience rating because they don't have a lot of layoffs. So right now, that means I think they're paying $25 a year or something like that for unemployment insurance. Over time, that isn't sufficient, I think, to sustain a lot of the trust fund costs. So one of the simplest things would be to say, okay, Table B is your lowest table. That was one of the proposals, so we modeled it, but nothing's changed on it. And individual employers, of course, move up and down in the table based on their claims experience. I do want to note one thing for the committee, which is that there was sort of a moratorium on looking back to the pandemic experience. That moratorium is ending, but it does mean that we kind of cut out, I want to say before July 2021, we sort of pretended that experience wasn't there. Like if it was worse for you as an employer, you didn't have to deal with it. So, the General Assembly found a way to try to smooth things out coming off the pandemic.
And the 1.9 billion trust fund balance, is that
Historically the highest it's ever been, or has it been higher than that in the past?
It's certainly higher than most recent years. I haven't gone back too much further. Let's see, I have the last couple of years. Do you have them up? What's the answer?
That's the highest it's ever been.
Highest ever been?
This is the highest it's ever
And
been.
are you all able to invest that fund, or are there restrictions on that?
Oh, yes, it is solely to be used for benefits.
No, but
for
are we able to
benefits
invest it?
towards, but we can't.
So you're not
can't- we
earning
can't do
anything
investments.
on that?
I'm sorry, say
You're
that again.
earning no interest or anything on those funds?
I can confirm for you, but I don't think we are, but I will confirm.
I mean, it's held in an account,
Wow.
but we'll find out.
So
what
where is it held, in a bank, or?
it's held in held in an account.
I'm sure they appreciate that, so.
I mean, I think this is one of those, we work with the comptroller and treasurer, like, we have all these rules about who holds the account and how that's managed. The department doesn't directly hold it.
So the
but we will
comptroller
check with
doesn't
them.
invest those funds, they're not allowed to invest the funds? I mean, we're talking CDs
Yes,
or whatever, you get
exactly.
5% on
We
it.
will need to get back to you, Delegate. I apologize, I don't know the answer on that, off that.
Okay, all right,
Yeah,
thank
we
you.
will find out.
Thank you, Mr. Chair. Thanks for the modeling. We've wanted these for a very long time, so it's really good to have it and to have the ability to model a couple different scenarios as we consider changes. Can I just clarify a couple things? On the slide that shows the path of the average high cost multiplier, we have the dip that happened in COVID, and then it's a major jump up. And you may have said this, but I just want to confirm, the most significant thing that affects that is was it $1 billion that we took of federal aid and put it in the trust fund? Is that right?
I want to say it was 800 million, but it could have been more, it was a significant amount, exactly.
So some of that, I mean, you spoke to the fact that we have record low unemployment, which certainly contributes to that, but some of that is the 800 million or $1 billion that we moved in there from federal aid, right?
Yes.
And that was, I think, done to cushion the blow that would have happened on employers at that time. And the only reason I think it's really important to make sure that we're aware of that is as we're thinking about what likely future scenarios would be and how likely the trust fund would be to bounce back from a future recession, unless we had $1 billion hanging around to move in there. That's a very unlikely response from a future recession. Like, would you agree with that?
Exactly. There was, sort of an emergency response, and I think Mike said something about it, it tends to bounce back quickly, but this is not a natural bounce back, at least in this most recent crisis.
And when it bounces back quickly, it's because people are paying higher taxes. Right? I
Yes.
mean, that's not, just doesn't bounce back quickly on its own. So just like for that context is important. The second thing I wanted to ask you to speak to a little bit more is so you modeled, based on our conversations, thank you, the increase in benefits. And I just wanted to ask you to speak about benefits for a little bit, because right now I'm trying to find it, I'm not sure yet, hang on. Where's the increase in benefits? Is that page?
12, the impacts of adjustments to taxable wage-based benefits, is that the one?
Yes, that's the
Slide
one.
12.
12?
Slide 12.
So right now, what is the maximum benefit amount?
It's $430 a week.
And so that's like, if someone might right now be earning $1,000 a week, they would get 430, 2,000 a week, they get 430, 430, they'd get a little under 430. What is 430 in terms of, like, as it relates to the minimum wage? Like, how does that relate to, what would that be if someone were working full-time and getting $430?
I mean, it's below the current Maryland minimum wage. I want to say, is it like 20-some hours? Yeah.
Yeah, I don't have the math on me.
It's something
right
like
now.
$12 an hour, maybe?
It's, yeah.
Close to that? Yeah.
It's not.
Because it's taxed also. So it'd be like, it would be the equivalent of someone getting $12 an hour and being taxed on that, right? That's what, do you get taxed on unemployment insurance?
You do.
You do, yeah.
Okay. So do you think that that's sufficient?
Obviously, Delegate, it depends on where you are, but, $430 is in a high-cost state like Maryland. It's not a adequate replacement for many people.
I'm going to jump in here, Secretary. It's not your job to answer those policy decisions that we can make. I understand.
I'm
People
interested in her opinion on it.
Yeah, she doesn't, I don't think that you have to answer that direct question, Madam Secretary, of whether or not you think that is sufficient. I think that is for the people around this horseshoe, not yourself. But keep going.
Thank you, Mr. Chairman. Obviously, it isn't sufficient to meet costs for many people.
So there's been 2 incidents where we've had mass unemployment and a lot of attention to unemployment insurance in the last 5 years. And one of them was during COVID, and the second was when the bridge collapsed. And during both of those times, did we expect people to live off of the $430, or did we have supplemental unemployment insurance for them?
I will say in both of those instances, in one case, the federal government obviously stepped in and made payments. In the case of the bridge collapse, we sort of had a hybrid approach. We had an additional $430 a week that went for either individuals who were not eligible for unemployment, so people who are independent contractors, because we recognized they were out of work, but there was no other means, there's no safety net for them, or in some cases it plussed up on top of their unemployment if they were eligible. Many of those individuals were very, very highly compensated workers at the port. I will say this, the thing that is not a good idea for sure is to have a sudden increase like this. It's much better if it's programmed in, right? Having to suddenly administer a benefit like what happened during the pandemic, first of all, it was a huge fraud magnet. And second of all, we were fortunate in the bridge in that it was a very circumscribed universe of people, and we asked people to basically check in with us, in many cases in person, so we could verify them one by one. It is very difficult, and it's a shock to the system to have to administer sudden additional new benefits. So I would just say if this body is considering those sorts of things, whether it be generally or in an emergency situation, it is much better to plan for it ahead. It's very difficult for us to adequately and safely and effectively do it if it comes in on an emergency basis.
So if we were to move towards increasing the maximum benefit amount, you're saying that we ought to phase it in over time, or you're talking about in response to emergencies?
It's very difficult to have a sudden emergency plus up, right?
Okay.
So like, oh, we've decided let's
But
add
if you
another
knew that we
$200
were-
because it's not adequate, like do it in 2 weeks, like that's incredibly difficult.
But if we passed a law and it went into effect in a year, you could,
It would take time, yes, certainly. It'd be better to know much further in advance.
okay. Thank you, Mr. Chair.
Thank you, Mr. Chairman. Mine is just an informational question. You mentioned the structural funding deficit and that some states use federal dollars to pay the administration fees. So my question is just that, do we have to pass legislation for you to do that, or how does that happen if you want to start to do that?
Yes, thank you, Delegate. So everyone gets some federal dollars. The problem is the feds have cut the reimbursement rates. Many states have passed their own separate, it's a state law administrative fee, and we do need to pass it. It has to be a separate, the Federal Department of Labor has been very clear and has penalized states who don't do it this way. They've been very clear, you cannot take it out of the general tax contributions or out of your trust fund. You gotta have sort of a separate little line.
So a new
Yes, you have to have a
stream.
designated line. We do have what's called a safe fund under Maryland law that exists already that's able to be used for unemployment administrative expenses. It's on certain penalties and interest, but obviously you can't count on that year to year. You're not sure what's going to happen, especially when they're relatively low claims. Those tend to be lower. So we would need to, have specific legislation, and the department and the administration has put that forward.
And so you create this new stream and you just take so much money, a little each time to build it up? Is that how it's
Yes,
happening?
our proposal's 0.15% of the annual UI tax contribution. So on a maximum taxable wage base of $8,500, because some people have lower wages than that for a given worker, that comes out to $1,275 a year
Okay, thanks.
on an individual employee.
All right. Seeing no other questions, just Delegate Weibel, you can earn interest. This is just Google, but you can earn interest on your trust fund. Might be worth looking into finding a different vehicle and working with the Department of Labor.
I apologize, I just don't know off the top of my head how
No.
our arrangements are. Yeah.
Yeah. I would
Check
also
in
be
with the comptroller
curious
and treasurer.
where it's stored, because some banks got to have it.
Yeah.
And so I'd be curious what that bank or who that bank is.
I don't know if our council wants to add anything. No? Council, do you want to say anything? Our principal counsel. Nick
I
Sutcliffe.
can't speak for the legislature, I can tell you.
Oh, jeez, okay, fine. We'll get the answer to you, Mr.
Is he
Chairman.
nervous? You can come up? No?
I don't know, our counsel doesn't want to talk. Stay in the shadows.
It's a shock for an attorney. Usually the one that sits here talks a lot. No. Okay, seeing no other questions? Yep, just a reminder for this evening that there is an event that some would say is expected, others would not. But with that, that concludes today's hearings. Thank you all so much.
Thank you.
I don't know.
Not
Or not to be charged, we collect.
we.